Legal aspects. Congratulations for making a sound decision. You and your family will definitely appreciate the benefits of the plan because it will provide you funds when you need it most. A life insurance plan provides a promise of benefits to clients, and this is specified in the life insurance contract. It is defined as a contract whereby a party for a consideration agrees to pay another a certain sum of money in the event of the latter's death from any cause not expected in the contract, or upon surviving a specified period of time or otherwise contingent of the continuance or cessation of life. In life insurance, there are two parties to a contract: the insurer and the insured. The insurer is the company authorized by the Insurance Commission to sell life insurance policies. It may be categorized as either foreign or domestic. Foreign companies are incorporated under foreign laws, with home office located outside the Philippines. Domestic companies are incorporated under Philippine laws, with home office located within the Philippines. Life insurance companies can be stock or mutual. Stock companies derive capitalization from sale of stocks and are owned by their stockholders. Mutual companies are owned by their policy owners. Another party to a life insurance contract is the insured. The insured is legally qualified to enter into contract for as long as he is of legal age, 18 years old and above, and of sound mind. This means that the insured understands his obligations and accepts the provisions of the life insurance contract. A life insurance agent is not a party to a contract, but is a representative of the company with which he or she maintains a contract in terms of distribution and selling of products. Aside from the insurance agent, an insurance broker may sell the products of a life insurance company. However, a broker is not under any contract with a life insurance company and may represent other companies as well. They do not have loyalty to any life insurance companies, but only to their clients. Consideration refers to premiums that must be paid to the life insurance company for the policy to take effect. The sum of money is the face amount, or sum insured, which will be given based on certain conditions specified in the contract. Death benefits are paid upon the demise of the insured, while maturity proceeds are given while the insured is alive and the life of the policy has ended, as indicated in the contract. A life insurance contract is a legal agreement between the insured and the insurer. It typically possesses a number of characteristics which is not widely found in other types of contractual agreements. It is unilateral. From the prefix uni, or one, means that there is only one party, the insurer, who makes a legally enforceable promise. Once the insured has paid the premiums, or as long as he continually pays it, nothing else is required from him. Only the insurer can be held liable for breach of contract. It is aleatory because the premiums paid by the insured and the benefits paid by the insurer are not necessarily equal. For instance, the insured paid 10,000 pesos as initial premium. After several months, died because of natural illness. The insurer will pay the face amount of 1 million pesos. It is a contract of adhesion because it is the insurer who drafts the contract and presents it to the insured on a take-it-or-leave-it basis. The insured does not have the option to negotiate, revise, or delete any part or provision of the document. It is a conditional contract because the payment of benefits is dependent on certain provisions or limitations. For instance, medical benefits may only be paid upon the insured becoming sick or getting injured. Further, the proceeds of the policy will only be paid to the beneficiaries upon the death of the insured. It is a contract of utmost good faith. Each party relies on its representations and declarations. The insured and the insurer must have a reasonable expectation that the other party is not attempting to defraud, mislead, or conceal information, and is indeed conducting themselves in good faith. Therefore, they have the duty to declare all material information which may affect the decision to either enter into or decline the contract, or if such data is not fully disclosed, would give the insurer the right to void the contract. It is a valued contract because the insured and the insurer agree on an amount or benefit to be covered and paid. Contracts are used in many areas of everyday life, such as when buying a car, home, or insurance. It is the legal way of formalizing the agreement between parties. For it to be valid and enforceable, it must contain fundamental elements. It consists of obligation, consideration, contingencies, and legal purpose. There is obligation on the part of the insurer to make sure that promised benefits are paid when all conditions of the contract are met. On the part of the insured, he needs to pay a consideration or premiums to enjoy continued coverage of the plan and payment of benefits upon happening of any of the contingencies, which are death, disability, and old age. The contract must have a legal purpose, which means that it must be in accordance with the provisions of the law, because it affects the public interest. A contract will only be valid if there is mutual consent from both parties. The insured and the insurer enter into a contract accepting each other's rights, limitations, and obligations. There must also be insurable interest that must exist between the insured and the designated beneficiaries. Insurable interest is the relationship that exists where one suffers financially in the destruction of the other, or continually gains from the existence of the other. The wife and children would have insurable interest over the life of a father who is the breadwinner. This is because they will experience financial difficulty upon the loss of income of the breadwinner that supports them. The insured can designate anyone to receive the benefits of a contract for as long as there is insurable interest that exists. This must be established at the inception of the policy.
Who can I designate as beneficiaries with insurable interest?
Everyone has insurable interest in one's own life, because one may suffer financially when he or she can no longer work, if disabled, or when income stops. Insurable interest is automatic in cases where there is blood relations or because of marriage. Insurable interest may also exist between a creditor and a debtor, because the creditor is bound to suffer financially should the debtor die when his obligations remain unsettled. All relationships that are pecuniary in nature, which involves financial matters, would have insurable interest. Insurable interest is important in naming qualified beneficiaries. Without the presence of it, it is said to be contrary to public interest because it allows the insured to be interested in the destruction of the subject matter rather than its preservation. It gives a temptation to make sure that the event specified in the contract happens so that the insurance becomes payable. However, the law imposes some restrictions in beneficiary designation. Under Article 739, Article 2012 of the Civil Code, there are relationships among individuals that will not qualify for donations to be received. Therefore, these persons cannot be named beneficiaries. Those made between persons who are guilty of adultery or concubinage at the time of the donation. The common law wife cannot be named beneficiary because the legal wife, by virtue of marriage, has insurable interest on the life of the insured. Those made between persons found guilty of the same criminal offense. Convicted felons cannot name themselves as each other's beneficiary. Public enemies cannot be named beneficiaries. Those made to a public officer or his wife, descendants or ascendants by reason of his office. Public officers are prohibited by law to receive favors or donations because of their position. They may not also be designated beneficiaries, including their relatives. A life insurance policy is no different from a civil donation. A beneficiary is like a donee who receives the benefits of the policy. Beneficiaries designated by the insured may be classified based on the priority to receive the proceeds of the plan. A primary beneficiary or beneficiaries are those who may have priority over the death proceeds of the policy. Secondary or contingent beneficiaries are those who will receive the death proceeds if the primary beneficiaries are no longer around and no other primary beneficiaries were named. Or it may be given to the estate when there are no persons named as beneficiaries, or if there are no living primary or contingent beneficiaries. This means that the proceeds of the policy will go to the executors or administrators of the insured to be distributed to named heirs. They are a class of persons who would take the property of the insured in case he dies. Jess, the insured. Robert, the primary beneficiary. And Mary, the secondary beneficiary, died in a common accident. It was established that Jess died first before Robert and Mary. Mary died after Robert. The question is, to whom should the benefits of life insurance be payable? According to law, the insurance proceeds is payable to the estate of Robert. This is so because at the time that Jess died, proceeds would have been paid to Robert. However, unexpectedly, Robert passed away. Therefore, it will be given to his estate to be distributed among his heirs. Mary and her estate, the contingent beneficiary, will receive nothing because she will only receive benefits if the primary beneficiary predeceases the insured, and there are no other named beneficiaries. It could have been given to Mary's estate if Robert had died before Jess and Mary after Jess. In cases where two persons, the insured and the primary beneficiary, perish in the same calamity, such as wreck, battle, or conflagration, and it cannot be proven who died first, the survivorship clause shall follow. If both were under the age of 15 years, the older is deemed to have survived. If both were above the age 60, the younger is deemed to have survived. If one was under 15 and the other above 60, the former is deemed to have survived. If both was over 15 and under 60, and the sex is different, the male is deemed to have survived. If the sex is the same, the older. If one was under 15 or over 60, and the other between those ages, the latter is deemed to have survived. Missing persons can be declared dead after 4 years, only if they are on board a sea vessel lost during sea voyage or aircraft which is missing. They are a member of the armed forces and have taken part in armed hostilities. They have been in danger of death and existence has not been known for 4 years. Otherwise, missing persons shall be declared dead after 7 years. Only then that proceeds of life insurance can be claimed. The insured client may specify his beneficiaries as either revocable or irrevocable. Revocable beneficiary designation means that the insured maintains full ownership of the policy. There was no transfer of rights when the beneficiaries were designated, which means that the policy is a property of the insured. The beneficiaries only have the right to expect benefits from the proceeds. The insured has the right to change or add more beneficiaries as he or she wishes. Irrevocable beneficiaries, on the other hand, is granted vested rights to the proceeds of the policy. He transferred some rights to the beneficiaries when he designated them. Therefore, he cannot change or add beneficiaries without getting written consent from all his irrevocable beneficiaries. Taxes are levied on proceeds of insurance. They are estate tax and income tax. Estate tax is levied on the transfer of rights from the deceased person to the legal heirs. Once the insured client designates revocable beneficiaries, the proceeds of his policy become part of his properties, which shall be subject to estate tax. The government will make an assessment of the value of the properties to determine the amount of tax to be paid before a transfer to legal heirs may be executed. If the insured client designates irrevocable beneficiaries, proceeds of his policy do not become part of his properties and will not be subject to estate tax. This is so because he has transferred some rights to his beneficiaries when he designated them. His only remaining right is to stop premium payments. Income tax is levied by the government on the income of individuals. Death proceeds are not considered income. If it will be given in lump sum to the beneficiaries, no tax will be levied. However, if the beneficiaries decided to leave the face amount to earn interest, the interest earnings will be considered income and will therefore be taxable. Maturity proceeds are taxable because the insured gained from the amount he paid as premiums. The excess of the total premiums will be considered for taxation. With a life insurance contract, insured clients are confident that the benefits of the plan will be paid as promised. Risk selection. The insurance business is a business of risk. The purpose is to reduce the effects of life's risks, which are death, disability, and old age. Every day, as a life insurance company accepts applications from clients, it has to ascertain the amount of risk it is willing to accept. Risk appraisal is a process whereby a number of factors are reviewed, such as health condition, occupation, hobbies, that tend to shorten the lifespan of individuals. Determining individual risks is called underwriting. This is being done to determine fair and equitable premiums, to be paid by the insured and to safeguard against anti-selection. Anti-selection happens when those with health impairments or greater risks apply for insurance and insure heavily. There are a number of risk factors that must be considered in risk appraisal. Physical factors include age, build, family history, physical condition, personal medical history. Age is important to consider in underwriting because the chance of illness and death are greater as one ages. Age-related sicknesses may include arthritis, Alzheimer, glaucoma, and others. On the other hand, deaths in children below 6 are significant because of their undeveloped immune systems. Build is a proportion of height, weight, and girth. When height, weight, and girth are not proportional, it poses an added risk to one's health. Overweight individuals are more prone to diseases such as diabetes, hypertension, heart attack, and stroke. Underweight individuals, on the other hand, are prone to have diseases of the lungs, cancer, and other related illnesses. There are apparent physical conditions of people having life-threatening illnesses, such as those who suffered stroke would have slurred speech or numbness and paralysis of a portion of the body and face. Those with hepatitis would have yellowish skin and eyes. Those who are smoking would have dry mouth, dark lips, and stained teeth. Those with lesions or wounds that do not heal could be a sign of diabetes. Those with shortness of breath could have lung disease or chronic asthma. The personal medical history includes hospitalization and sicknesses during the lifetime of the individual. This is important because there are some illnesses that can recur and cause major health conditions in the future. For example, tonsillitis can lead to heart disease. Diabetes can lead to kidney failure. Family history can provide information on the eventual sickness or cause of death of other family members. This is because they are exposed to the same virus and bacteria, they share the same lifestyle, or they are predisposed to the same kind of diseases, like asthma, cancer, tuberculosis, diabetes, tumors, and heart disease. Occupational factors could increase the risk of death, sickness, or disability. There are those with occupations that are accident-prone, such as carpenters, drivers, field engineers, electricians, military personnel, seamen, stevedores. There are occupations that expose individuals to unhealthy working conditions, such as asphalt workers, building workers, factory workers, miners, farmers, while individuals who are exposed to social hazards are entertainers and social workers. Financial factor is also a consideration in the underwriting of an application for purposes of determining the need for insurance and the capacity to pay and sustain premium payments. Morals are behaviors that can shorten the lifespan and increase the risk of death. Examples of which are infidelity of the spouse, smoking, alcoholism, drug addiction, and gambling. Avocation or hobbies are activities that can increase the risk of disability, sickness, and even death. These are mountain climbing, scuba diving, parachuting, skydiving, car racing, and motorcycle racing. extra premiums may be paid to cover risks of individuals engaging in any of the dangerous activities. Residence, place of work, and travel may increase life's risks. Individuals who reside in areas with unhealthy living condition, unstable peace and order situation, and chaotic places such as clubs, disco bars, where there are rampant fights and squabbles, have higher risks. Agents observe and gather information based on the factors for consideration in underwriting policies: physical, occupational, financial, morals, avocation, and residence and travel. The information on physical, occupational, financial, morals, avocation, residence, and travel must be gathered from reliable sources. Agent. The agent is the company's representative whose role is to make observations and gather information about the client that will help in the assessment of risks. Application form. The application form contains all information about the client, which is material to the risk assessment. The information declared are mere representations, which are held true at the time of application only, and not promissory warranties. A promissory warranty is a statement about future facts, or about facts that will continue to be true throughout the term of the policy. Medical examiner. The medical examiner conducts physical checkup for the purpose of getting a life insurance policy to know his current health condition and his medical history. Attending physician. The attending physician's statement on date of illness, diagnosis and treatment, duration of illness, and date of relapse or recurrence is important in underwriting risks. Inspection report. The inspection report summarizes information about an applicant for a policy, including financial standing, morals, physical condition, habits, and other information. Financial report. A financial report may be composed of income tax return or annual statement, which could support the client's statement of income to determine appropriate coverage and prove the client's capability to pay premiums. Medical Information Bureau. The Medical Information Bureau is also known as the clearinghouse of all life insurance companies. Information about declined applications from member companies is stored in their database for use by other insurance companies in evaluating new applications. Information in the database is coded and may only be accessed by authorized individuals in the company. The information gathered from reliable sources will then have to be assessed and classified by home office underwriters. This process is called classification of risk. Client's risk may be classified as standard, substandard, declined, or postponed. Standard risk means that a person has less than the usual tendencies of getting sick or being disabled. Substandard risk means that a person has more than the usual tendencies of getting sick and being disabled. Life insurance companies can still accept substandard risks. However, to compensate for this, it is classified further as modified or rated. Modified coverage means that some provisions of the plan are limited. For instance, riders may be removed or liens may be enforced. Rated coverage means that the risk may be accepted, but additional premiums are required, such as an extra premium of 5 pesos or 10 pesos per 1,000 of coverage. Pregnancy extra is an example of a rated coverage wherein the insured is given an option to pay extra premiums amounting to 5 pesos per 1,000 of coverage to cover pregnancy-related deaths. There are cases wherein the risk of the person applying for life insurance is too high to be assumed by the life insurance company. In this case, it will be declined. There are also instances wherein the life insurance company cannot accept the risk of the person at the time of application, but may still be reconsidered after a certain period of time. For example, a company may not accept 7 months pregnant applicant because the risk of pregnancy is too high, but may be reconsidered 2 months after giving birth. A life insurance company may still provide coverage to substandard cases. However, to limit its risk exposure, liens are applied. Liens are limitations in coverage. Juvenile lien. A juvenile lien is a limitation in coverage for children below 6 years old. This means that should death occur and the child is below 6 years old, the death benefit is limited to a certain percentage of the face amount. Pregnancy lien. A pregnancy lien is a limitation in coverage for pregnant women. This means that should death occur while the insured is giving birth, only a return of premiums will be paid. A life insurance may offer pregnancy extra to cover risks brought about by pregnancy. If this is chosen by the client, she pays extra premium. Aviation lien. An aviation lien is a limitation in coverage for civilian or members of the armed forces of the Philippines engaged in flying. However, a life insurance company may give an option for the insured to pay extra premiums to cover this risk. People from different walks of life will have different risks. A life insurance company will have to have gates to ensure that risks are within acceptable limits. In this way, it will not encounter adverse claims in the future, which may affect business expense.